Hey, everybody, welcome back. And guess what? It is, yes, you guessed it, 2025. So happy new year. So today's title, right? Home prices remain the housing market's biggest mixed blessing. What the heck does that even mean? We're going to go over that. We're going to go over December stats. With that, we're going to take a look at the same metrics that we do each and every week so that you can really know our market, our local market, which is half of Washington State, 3/4 of Washington State. So you can understand where are we going, what should we expect, what are we going to see in first quarter, second quarter, Q1, Q2, and let's get the show on the road. Well, that's not the right button. Let's try a different button. All right. So, it's funny, every once in a while we run into a glitch and, a lot of folks are like, George, is this choreographed? Is this scripted? Are you reading off a teleprompter? No. And many of you that watch the show will realize, no, I actually go through this live. So when I make a mistake, I guess we make a mistake, right? Then there it is, a mistake, because, well, it is what it is. And besides, who wants to listen to something scripted? That's not very exciting. So the question is, when we talk about the market and pricing and affordability and why is it that double-edged sword or that mixed blessing, right? Well, let's open this up, right? And as you can see, we saw roughly in our area a little bit more than 4.5% appreciation on a nationwide level. It's about 4 to 7%. And when they take a look at, is it sustainable based on home value growth versus income growth, and we take a look at affordability, well, that becomes a massive question, because as interest rates have been creeping up, even though it's been relatively flat, since December, when the Feds, quote unquote, reduced their rate, which has nothing to do with mortgage rates. Okay, they can impact or affect mortgage rates, but they do not control them. And we'll watch other issues. I'm not going to go through that one again today. But here's the nut. When we talk about affordability, we talk about everything that is happening as far as appreciation versus income, versus the economic stability, which each and every, area. If we actually come back and we take a look at just the big picture, you can see that everything that is happening is, well, it's kind of situation normal. We have the same conversations, it seems like, every year. Even, in 2020, when everybody was saying, oh my gosh, the market's going to crash. Go back and watch, my February, Jan, Feb, March of 2020, when COVID was coming into play. I guess, I don't know, are we allowed to say that anymore? Sometimes YouTube axes us when we say that, but you'll see that we were bucking the trend. And so you're going to get some really solid information. Same thing here. When we start taking a look at everything that is happening, it's situation normal. This is a conversation I've been having my 33 years of real estate. Oh, there's just no way home prices can keep going up at the rate that they are. And there's no way that home prices are going to double every 7 to 10 years. That's just not possible. They've been saying that since I started in real estate, ever so long ago. Anyway, with that being said, understand, more than likely it will, because that is what happens. Inflation, until inflation actually starts subsiding, we're not going to see much. Are we going to see a depression? No, I don't think we're going to see a depression. Will we see a recession? We have been bouncing off of that recession statement for a long time, right? A true recession, right? 2 consecutive months of minus GDP, gross domestic product, right? Okay, we've been bouncing pretty close to that. And the reality is, some folks are saying, oh gosh, I hope we don't see a recession. And you know what? To a degree, I get what they're saying, because when you do, mortgage rates almost inherently, well, historically, they have come down every single time. 100%, they've come down every single time. Market real estate takes off. Economy hits the recovery. Home prices go up. First-time home buyers become basically about 38% of the market share, which shows that recovery. And then as that transitions into move-up buyers, then where the move-up buyers become about 38-40% of the market share of the transactions, then first-time home buyers actually take a second seat, back down to about 27%. Okay, that is a normal cycle. Will we see that? I think that we are going to see something kind of a hybrid. I think we're going to see something very close to that as we come into to the spring market. The real question is and what will really make the biggest determiner are going to be mortgage rates. Hands down, as we've been getting closer and closer to the consistency of the 6.75, 7% as far as mortgage rates go, well, that's going to be a little bit of a challenge. But as they get down into 6.25, 6.02, like they were in September, well, you know what? Our market is going to take off, and a lot of craziness is going to happen. We're going to see home prices continuing to head northward, whereas, I'm actually expecting this year to see, an appreciation subject to rates somewhere in the 8%. Yes, I know. I'm sorry. It could even hit double digits. It just depends on a lot of the mortgage interest rates, which I think are going to start to come back down. And I think we're going to see the low sixes, which is going to spark a lot of that activity. That's my prediction. But if we continue on and we take a look at our headlines here, it says, hey, listen, upper left, hey, home prices remain the housing market's biggest mixed blessing. I guess that's a mouthful. On the bottom left there, mortgage rates haven't moved much since Fed week. 100% accurate. Of course, it's red as far as the movement that we saw yesterday, because it went up 0.3. And so when we take a look at rates, and that is a trading rate there that you see, that's super important because, listen, again, the Feds do not control mortgage rates. They only meet once every 6 weeks. Whereas the mortgage rates, they go up and down every single day, every hour. And it just depends on what lenders want for a price point. Here's a better way of saying it. The Fed rates are what the banks borrow at. How's that? We'll keep it simple. What the banks borrow at. I said I wasn't going to do this. We're doing it anyway. Okay. Then remember, because banks need to make a profit to keep their lights on and their doors open, just like all businesses, right? They need to charge a profit, or that's called a margin, right? So if the Fed rate, which they reduced to 4.5, depending on where you're looking at, then the banks charge anywhere from 2.5%, 3%. Well, when we said our pricing, when we come back one here, let's hang on, let's do this. There we go. And we talk about the red chart, upper right-hand corner. All right. That shows 7%. Well, if Fed rate's at, say, 4, and a bank wants profit of 3%, they're going to charge 7. Well, lo and behold, there it is, right? So those are the rolling rates, and that's something to keep in mind. If you want to know a deeper question, go to the bank and say, hey, bank, what do you charge for your margin? What is your margin projection for this week or this month, this quarter? And they're going to say, well, it's going to be prime plus. It's prime plus 2.5, prime plus 3, whatever that is. You can go back and say, here's the Fed rate, and here's their rate. But it bobbles up and down. It's traded on the stock market. And so that's why rates adjust and fluctuate the way they do. But that should give you a little more clarity because of the calls. Like, I've received a few calls like Dan Golden did on the video we did not long ago that said, George, it's amazing. Rates are down to 4%, 4.5% again. I'm like, time out. No, that's the Fed rate. That has nothing to do with mortgage rates. All right. If you have a credit card or a HELOC, hey, that's a winner chicken dinner, because then your rates went down. Again, that's prime plus. All right, moving on. So as we kind of move on, let's take a look at Freddie. What did Freddie say? Freddie says their running 7-day average is at 6.91%, which is about 1/3%, or 0.29% higher than where it was this time last year. That's a real wiener. And then, of course, as you can see, where we had our dips, and you see where it says Fed, that's where the Feds did their rate drop. And of course, as you saw, mortgage rates went up. And that has been a consistent pattern over the last year and a half. Where we saw last year and why we saw rates so preferable last year is they came from almost pert near 8 in September, and then through the month of October came down into the mid 6s, which then drove a lot of traffic. That's how we saw a massive influx at the end of 2023, which is similar to what we saw in 2024, because then as we take a look at what's going on, we see active listings coming on. We see homes going pending almost 2x. We have solds, which are consistently, which again, remember, that's what happened in December. When we take a look at our chart here, we can see that, last month, the month of December, year over year, 24 over 23, 2024 over 2023, we had basically about a 6-day average market time increase, or about 14%. As far as list to sales price, hey, it was spot on. It's about 96% last year, and it was the same in 2023 for the month of December. Now, granted, it is only the 4th of January, so our numbers today, when we take a look at year to date, they're still consistent. I mean, still, it's the first 3 days, right? 97 versus 96. However, 52 days on market average, which is a little bit higher, about 3 days higher than what we normally see. And, that's not unexpected, this time of year and whatnot. It still fluctuates. And is it situation normal? Sure. Can it fluctuate a couple of days without having any negative impact? Of course. It's peanuts. Really, what's going to start to happen as people start to kind of get back into the groove, February, which is going to be the beginning of your, I would say, your spring market, more towards the end of February. But definitely, March, April, those are going to be your hottest and heavy times. It's when you're going to see the biggest influx of homes coming on the market. You're going to see a lot of movement. And if we see mortgage rates dip into the mid to low 6s, it's going to be an interesting time, that's for sure. All right. If we pop this back up again, we take a look at, again, what's coming on market, or what we call our running 7-day average. Look, we had 391 homes come on market, residential only, on market in the last 7 days. We had 600 of them that went off market. And then, of course, 585, which are closing since December, which still shows, we had a very, very nice December, all things considered, as we were every single week pulling off more inventory than what was coming on. Not common, but not uncommon. We did see, because of some lower rates, we did see some really nice activity, which was nice. So remember, if you're looking for super accurate information with no marketing, well, there you go. This is where you need to dial in, take a look, and hey, we'll just keep you guys rolling. When we talk about December market trends, and as we move into our market times now, I mean, look, you can see 2023 and 2024 on the left, existing home sales, on the right, new construction, new home sales. You can see a very consistent pattern. And the only difference that you see is, the spikes, between 2020 and 2022. And of course, that massive fall off, that's when the interest rates went from 5% to 8%. Of course, sales fell off. But those are what we would call our outliers, just because that was such an anomalous time, okay? When we take a look at the charts, when we say, okay, George, when we talk about list price or average list price versus average sales price, okay? And this is a metric that's super important. We'll take a look at those both with new construction and with existing construction or resales, okay? it is important because it helps us with trend. It helps us to see, hey, how are we trending? What are we looking at? Are we in an upward trend, downward trend? Are we sitting flat or horizontal or sideways, as some people call it? Funny enough, it is common this time of year, and that's why it cycles down in December, picks back up again in the summer or spring, summer, and then kind of falters back down again. I shouldn't say falter, but it heads back down, and it's a normal cycle. And I just want to make sure you guys see that as we come in and we take a look at this. So for the month of December, our average list price, and that's the chart in the upper right-hand corner there, average list price was $936, which is just a tiny, tiny little bit less than the average list price of what it was in 2023. Now, when we take a look at the average sales price, that's where the tire hits the pavement. We were at 808,000 this last December, and in 2023 we were only 761, or a difference of about 6%. Okay, now that is situation normal. When we take a look at the chart down below, and we take a look at the average list price versus the average sold price, these are metrics again that we're going to see consistently through the time, and our pricing is holding firm. Okay, with new construction, it's been pretty flat. It's still a really good time until about the middle of January as far as getting pricing that has a lot of incentives. Okay, meaning that they're not going to adjust price necessarily for existing plats. Newer plats, they're coming in a little bit lower price, which is super smart because then they don't have to give as many concessions. But there are ways of getting an additional $10,000, $20,000 on new construction. But the agent that you are working with, since I don't recommend working with the site agent, they don't work on your behalf, right? But the agent you're working with needs to know how to negotiate with new construction. And if they don't, you might want to look at something different, or unless you're willing to leave $10,000, $20,000 on the table. I'm just saying. All right, moving on. As we move over and we take a look at what is going to be happening, hang on a second here, need to change charts. There we go. All right. As we take a look at this and we take a look at what happened in January as far as sales, hey, look, we're up almost 19% on pended. That is awesome. We were up 23.6% on actual closed sales, in which some of those you're going to see this month. And so part of our drive that we're going to see this month, and you see on the right-hand side, which is normal as that carryover, because people go into contract in December but won't close until January. Again, that's totally normal. Remember, looking at solds is like looking in the rearview mirror. Okay, but we look at pended, we look at active as far as that dynamic, what's happening in real time. Solds, it's looking back in history. How did the tire really hit the pavement, and what did those numbers actually look like? And as we progress through the year and we look at them year over year, we're able to get a pretty good definition of, hey, here's what's happening now. Here's what you should expect. Just saying. All right. When we move back and we move over to the actual, hey, how many homes are we seeing? All right. We're seeing about 10 less homes today. Wow, it's only the third as far as reporting goes. But it's still, we're there. Solds, hey, they're up just a tiny little bit. Again, way too early to tell. But when we look at our numbers from December, you can see, hey, we're doing super well. We had a really great December, all things considered. And even with existing construction or resales, they did super well also. And when we pop over and we say, hey, are they still offering incentives? The answer is yes, they are. And everything that we take a look at, everything is moving along. We're still seeing some, normal January lower numbers as things kind of bobble in. The however is when we take a look at actual numbers, listen, December again for new construction was off the chart, just like resales were. And you can see that our list to sales price, is going to be very much spot on. Velocity wise, again, December did really well. Let me open that up. December did really well. We were up 2.4% on pended. up 5.1% on actual closed sales. And then, of course, when we take a look at January numbers, they're right on target, right? I mean, it's only the 3rd of January, for heaven's sakes. That's why we look back on the prior month. When we take a look at bank-owned homes, all right. We've been getting a lot of inquiries on bank-owned homes. Again, I'm not sure if the books and tape people are rolling through again. It could very well be. Understand, we are, without a doubt, in the top 5 sweet spots across the United States. Our stability, we're actually, for affordability, we're 3rd from the bottom. Not a great number to be at. 3rd from the bottom, meaning there's only 2 other areas that are more expensive than us as far as affordability goes. Not necessarily home prices, but the actual affordability versus income. And there are some YouTubers out there that are using that as a precipice of saying, hey, oh yeah, Washington State, they're going to crash. I mean, look what happens to what's going on east of the mountains. And of course I laugh because they just don't know that east of the mountains are, this wheat fields. It's forest land. And so our core areas, Pierce, King, Snohomish, Thurston, and part of Kitsap, those are the core areas that we look at as far as our trends, our dynamics, our stability of employment, and how is our economy rolling. Look, we're one of the top 5 sweet spots across the United States. Getting back to it, foreclosures are super, 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 super low. I mean, super low. And why do we say that? Hey, if I just show you a chart here that just basically, it takes you from Marysville, Granite Falls, all the way down into Graham. Look, man, it's just a smattering of homes. That's like next to nothing. Now, the funny thing is, 8 of those little green houses that you see on the screen, those are not foreclosures. Those are just mismarketed homes, meaning that they are owned by homeowners. And unfortunately, the wall of shame agent has not changed the status. So you have to take, basically 5 of those off, 6 of those off. I think there were 6 actually. And that just gives you an idea. We don't have that many foreclosures. They do paint carpet and vinyl. And that is why REOs are not a great, quote unquote, I'm going to get a great deal. There are other areas to get a great deal. Those could be fixers. You can take a look at homes that are not distressed, where people just don't want to do the updates, and those are homes that you can go and capitalize on. Now, sure, because our inventory is still only half. I mean, we had 1.6 months of residential only, 1.6 months of inventory. Okay, you might say, George, what the heck does that mean? Well, that's super simple. It used to be, and I say used to be because that was over a decade, over 10 years ago, a balanced market was having 4 to 6 months of inventory. In other words, if I have a bucket, and I call this bucket the Northwest MLS, right? And all of the agents, everybody puts their listings in this bucket. And if I put a lid on it, and I only sell what's in this bucket, I should have 4 to 6 months of inventory in this bucket to sell for a balanced market. Well, that's not the case. We haven't seen that as a case in over 10 years since, really 2012. So 12 years, all right? Going to be 13 years here shortly. Anyway, when you talk about it, we look at it and say, okay, well, what is balanced market today? Well, about 2.5 months is a balanced market. That's what we saw really September through December. It kind of reaffirmed that the number of homes coming on and the number of homes going off market, meaning closed, pended, sold, that was in balance. We didn't see the craziness like in 2020 where we went from, 10,000, 12,000 homes all the way down to 2,800 homes, 2,500 homes. That was like no inventory, okay? In 2008, 2009, 10, we had, 20, 30,000 homes available. Absolutely bipolar to 2020, okay? Now, a balance for us coming on and going off is about 2.5 months of inventory. We're at 1.6 in December. We were at 2 months in November. As far as residential inventory, we're at right now about 1.6 months of inventory right now. Okay. Situation normal, a little on the low side. That's why we're concerned about mortgage rates. And, if they start really dropping, we're going to start pulling more inventory down. That's going to drive prices up. With foreclosures or REOs or bank-owned homes, right? We get back into this chart, you can see there's nothing there. There's nominal numbers, okay? Even our December numbers were super nominal. Sure, we had a bunch of pending because we started drawing down on a lot of inventory straight across the board. And as you can see, even January is starting off situation normal, just a couple sales, a couple coming on market, no frills, no thrills. Yeah, it's pretty straightforward. And again, if you're looking at foreclosures as being a great investment, hey, they're going to do paint, carbon, vinyl, they're going to get a market value, and they're going to get market price for it. That's all there is to it. So don't think that buying a bank-owned home is going to be a great value, because it's not. Anyway, there are other alternatives, and if you want to have those, ping me, and I'll shoot you some information, things to look at, and if you're working with an agent, tell you where to go look. All right. In the meantime, if you have any questions, you need to let us know, because we don't typically respond to you in about, 30 minutes or so. And remember to smash that subscribe button. Give us a share, to some of the friends that you like, and then one person you don't like. And then, of course, hey, like the video. It's so funny because most of you are not subscribers of the channel, but you enjoy the information. We get some really good viewership, but just, hit that like button. Just let us know that, hey, you're doing a good job. Keep the information coming. In the meantime, have an absolutely fabulous 2025. Happy New Year to all of you. All the best to you and your families. And in the meantime, stay dry out there, and I will see you on the next video. Take care.